The return on invested capital. Is this bearing dividends? Is the integration of generative AI throughout the ad offering vindicating that spending that actually they up for this year because of tariff costs?
Well, Caroline, I'll give you a couple of points on this. One, I think Meta is proving to show that at the app layer, the application layer, that you can get a good ROAI, return on AI spend. I thought the way Zuckerberg laid out the earnings call last night, the 5 areas of focus for AI for the company, and then the returns they're getting kind of within each areas of those focus. And they're applying AI to improve their ads platform. Well, the application of AI has allowed conversion rates to rise about 5%, which is a big number for an ad platform that's that huge. On the user side, they're trying to improve engagement. They're trying to make the content more personalized, more relevant. Well, they were able to show that the application of AI has led to a 7%, 6% increase in time spent on both Instagram and on Facebook. So yeah, I think they're proving that they can use AI to improve the service and actually monetize it. Like you can get a return on all that AI spend. I want to be careful though. I think extrapolating from Meta to other companies is a tricky thing to do. One, very few companies have spent as much money and as effectively as Meta has. And then Meta's advertising platform is just more resilient. I'm not at all sure that these companies are out of the weeds or out of the danger zone when it comes to the impact of tariffs.
So their argument, right, is that the time spent metrics are evidence of the resiliency in like tough economic environment. I felt like this story evolved over the course of this statement hitting to the end of the call, and this is the quote from Susan Lee on why. So the CAPEX range gets raised, and we're all thinking commitment to AI, even though they said it goes to the core of business. Then Susan gets asked about tariffs, and this is the answer. The higher cost we expect to incur for infrastructure hardware this year really comes from suppliers who source from countries around the world, goes on to explain uncertainty relating to trade negotiations. We're working on mitigations. The CAPEX range got raised because it's more expensive for them to build the data centers, Mark.
Ed, you nailed it. I think that's absolutely true. I mean,
I'm nailing it all day today. Keep going, Mark. Thank you.
I think there are 2 reasons. One is that I think they are getting more aggressive, offensive. They've seen the return that they're getting on their AI spend, and they're leaning into it more. The second reason, however, is that costs are rising. And I don't know if you noticed this, Ed, but she was very careful never to use the T word, i.e. tariffs.
Didn't use
that's
it.
a political... Yeah, it's a political statement these days, and nobody wants to get involved in politics. So she was very careful about how she answered that. But yes, the costs of tariffs are a tax. They're inflationary. And if you're buying a lot of infrastructure hardware, like Meta clearly is, and so are the other hyperscalers, by the way, your costs are going up. So my guess is that Amazon may have to raise its CAPEX, and Google's going to come back to us and having to raise its CAPEX. And Microsoft next year will probably have to raise its CAPEX numbers because the infrastructure costs are rising.
Based on market capitalization, Apple and Microsoft are the 2 most valuable firms in the world. NVIDIA now lags behind Apple and Microsoft in market value after losing around $1 trillion. With numerous tailwinds, NVIDIA may be able to boost growth for the rest of the year and regain the trust of investors. Compared to other businesses, the technology industry has seen unusually high levels of interest over the past 2.5 years. This dynamic is by no means unrelated to the relentless enthusiasm surrounding artificial intelligence, AI. However, it's noteworthy to note that a small concentration of mega-cap stocks is mostly responsible for the AI trend. Currently, among the most popular stocks in the S&P 500 are Apple, Microsoft, NVIDIA, Alphabet, Amazon, Meta Platforms, and Tesla, collectively referred to as the Magnificent Seven. By market capitalization as of May 1st, NVIDIA is the 3rd biggest firm globally, trailing only Apple and Microsoft. Let's examine a few of the variables that have affected NVIDIA's 2025 valuation. More significantly, I'll describe the factors that could propel NVIDIA to the top of the global market by the end of the year. It's been a rough year for NVIDIA. The stock has fallen 15% as of this writing, more than tripling the S&P 500's declines. The fact that NVIDIA's current market capitalization is almost $1 trillion less than its January peak helps to illustrate how much value the business has lost. Earlier this year, a Chinese startup named DeepSeek appeared out of nowhere, causing the first significant sell-off in NVIDIA stock. DeepSeek asserted that it used earlier NVIDIA architectures to create an AI platform that was comparable to several of the top models created in the United States. Investors briefly began to wonder what kind of demand there would be for NVIDIA's upcoming chipsets. Following weeks of in-depth analysis by technology journalists and Wall Street analysts, it became clear that DeepSeek's early claims were probably not all that accurate. The unpleasant tempest surrounding new tariff plans is at the center of NVIDIA's recent sell-off. More particular, as NVIDIA now faces a much more difficult environment with strong competition from Huawei, some investors are gravely concerned about the company's prospects in the Chinese market due to the ongoing conflict between the United States and China. Compared to Apple and Microsoft, I believe NVIDIA to be a more important contributor to the overall development of AI-powered services. In the upcoming quarters, I believe investors will be paying closer attention to both Apple and Microsoft. Growing tensions over the ongoing tariff crisis may have a negative impact on demand for iPhones both domestically and in the Chinese market. Google and Amazon present a fierce competitive environment for Microsoft, the company's main driver of cloud computing services, as several of the top technological businesses in the globe release their first calendar quarter 2025 earnings. Investors will be receiving a lot of updates now that May has arrived. Alphabet, Microsoft, and Meta platforms, all of which collaborate closely with NVIDIA, reported their earnings as of the closing bell on April 30th. Alphabet's management reiterated earlier projections to spend $75 billion on capital expenditures, CAPEX, this year during the company's first quarter call. Furthermore, Meta actually raised its previous guidance, while Microsoft doubled down on its own capital expenditure estimates for the second part of the year. Understanding these topics is crucial. The biggest clients of NVIDIA would probably reduce their infrastructure spending if they did not perceive strong demand for their own AI services. Big Tech, however, seems to have faith in the long-term possibilities of the AI revolution, despite a volatile macroeconomic climate. As a result, they are still willing to spend tens of billions on networking equipment, servers, processors, data centers, and other items. These factors, in my opinion, lend credence to the notion that NVIDIA ought to continue to be a leading supplier as IT behemoths continue to develop their AI infrastructure. Furthermore, among the Magnificent Seven, I believe NVIDIA is in the greatest position to take advantage of AI CAPEX tailwinds. For these reasons, I expect NVIDIA should observe robust demand for its GPUs and several other services throughout the second half of the year. I believe that investor sentiment will start to shift back in NVIDIA's favor once more, causing the business to be valued significantly higher than it is now and to overtake its Magnificent Seven competitors. So, what implications does this have for NVIDIA's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication, so if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on NVIDIA stock in the comments. Your support truly helps us grow. Now, let's get back to the video.
Look, we've had 3 years now of really aggressive deployment of AI to boost the ads business, to boost the platform for advertisers and for users, but also to roll out some new things like Meta AI and then Meta AI devices, maybe Ray-Ban, Meta Ray-Bans, maybe, and also to boost the WhatsApp business. And so I think they've shown that they can get a good return on this. I mean, they're good cutthroat capitalists like a couple of these other companies, and I think they're making rational business decisions. They're probably leaning a little bit more heavily than other companies, but it's paying off for them. I think you'll see other companies look at what Meta has done, and I think they're going to lean into AI as well. I know we kind of drifted away from the AI revolution earlier this year. I think we're going to come back to it. I think Meta's going to give us good reasons to do that.
Yeah, they're bringing out Meta AI app as a standalone. We've seen also the levers being pulled in terms of advertising when it comes to threads. How does that filter into WhatsApp and other offerings more broadly, Mark? But you said you can't read across from Meta into perhaps other social media companies like Snap, because Meta ends up being like the port of safety in that respect. But read across to Amazon in terms of cloud. And indeed, you say that Amazon might have to raise their spending on infrastructure spending in that respect. But where else does AWS take us in terms of growth?
Well, I just think if the infrastructure hardware is more expensive for Meta, it's more expensive for everybody, and so that's going to be the case with Amazon too. I think they may well have. I mean, I think the direction of AWS CapEx is going to go up unless but things could change quickly in this tariff environment. But for now, those hardware costs are going higher, and so that's going to probably be reflected in rising CapEx spending. And then just a point on Meta. I think their model is more resilient. Also, we haven't really seen the dramatic economic dislocation. Now, our checks indicated that you started to see some ad verticals really soften in the month of April. We still have the whole year ahead of us, so I don't think Meta's out of the woods. My only point is that relative to almost every other ad platform, they're more insulated, they're more resilient than anybody else. But even if there's a sharp economic downturn, they're not going to be immune to it.
And Mark, it's the Chinese retailers that pull back on ad spending. What about Amazon's e-commerce business?
I think that's going to be TBD. I think the March quarter is going to be fine. Google gave us a fine March quarter. Meta just did, and I think Amazon will too. We haven't seen any sharp fall off yet in consumer spend, but prices are rising. They're going to be rising materially. Those dolls are going to be more expensive on Amazon, and so exactly how Amazon handles that, whether they're going to eat margins or defend market share. And my guess is that, knowing Amazon, they're going to defend their market share, so they're going to be willing to take a hit to margins. So that could be a downside to the stock. So it depends. Prices are rising on Amazon. That's not a good thing for the Amazon ecosystem.
NVIDIA's stock is taking a break after a 2-year run of unrelenting growth. The stock is trading lower due to concerns about U.S. trade restrictions and a potential slowdown in AI spending. Nearing a 3-year low, NVIDIA's value is becoming more appealing. The last few years have been quite hectic for investors in NVIDIA. Demand for the graphics processing units, GPUs, that enable artificial intelligence, AI, has skyrocketed since the start of the AI revolution. Being the top supplier of these cutting-edge chips, NVIDIA has undoubtedly benefited, as evidenced by the more than 8-fold increase in its stock price in the 2 years leading up to 2025. But in the last few months, the story has become distinctly negative. NVIDIA's stock is down nearly 25% from its top as of this video, due to a combination of U.S. export limitations and worries about the AI spending boom slowing down. However, NVIDIA investors received much-needed positive news in the form of comments from 3 of the company's largest clients. Big Tech's capital expenditures skyrocketed due to the requirement for servers and data centers with the processing power required for AI. NVIDIA's data center division produced 6 consecutive quarters of triple-digit year-over-year growth, fueled in part by this expenditure. The stock fell, meanwhile, as a number of stories indicated that some of NVIDIA's largest clients were cutting back on data center expenditures. The details are crucial, though, and it turns out that the sky is not actually falling. The results of Microsoft's fiscal 2025 third quarter, which concluded on March 31st, were surprisingly good and fueled by a high demand for artificial intelligence. Azure Cloud was the high point, growing 33% year-over-year and faster than its 31% increase in Q2. The fact that 16% of the growth, up from 13% points in Q2, was attributable to AI services was perhaps more astounding. Reports of a slowdown in data center spending were dismissed by CEO Satya Nadella, who said it was just the typical ups and downs of regional data center planning. "We've always been making adjustments to build, lease, what pace we build, all through the last 10-15 years, said Nadella. The company wants to make sure that the regional data center build-outs match the demand, he continued. Being upside down, with too much capacity in one area and not enough in another, is what they want to avoid. Similar worries were raised about Amazon's data center spending slowing down. The reports were denied by Kevin Miller, vice president of global data centers at Amazon. He pointed out that there hasn't really been any notable difference. Demand is still quite robust, and we're looking at the numbers only going up over the long run as well as the next few years. Meta Platforms made an unexpected disclosure that attracted attention when it released its first quarter results. At the midpoint of its prediction, the business announced plans to raise its 2025 capital expenditures, CAPEX, spending from its previous estimate of roughly $62.5 billion to $68 billion. This updated outlook reflects an increase in the expected cost of infrastructure hardware and additional data center investments to support our artificial intelligence efforts, the business stated. As the top supplier of GPUs for AI in data centers, NVIDIA stands to gain from the continuous expansion of data centers. This will facilitate AI's continued and rapid deployment. To stay informed about the latest developments from NVIDIA and the ever-changing stock market, consider subscribing to our investing tutorial channel. We provide daily updates on significant market shifts and key catalysts, so hit that subscribe button to ensure you never miss crucial information. We'd love to hear your thoughts on NVIDIA stock, so please share your opinions in the comments below. Now let's dive into today's video.
Tiers. Trump officials are now reportedly weighing country-by-country deals instead. Deirdre Bosa has more on the significance of what sounds like kind of an engineering or a workshopping kind of change, Deirdre. What is it?
Also more of what we've seen so far this administration and this prospect of deal-by-deal chip access, that's certainly unsettling investors. So let me go over it. Right now, U.S. chip exports, they're governed by a global tier system, as Kelly said. Allies get more access, adversaries get limited, or they get blocked altogether. Replacing that with a country-by-country deal system means that semis become leverage in the trade negotiations. And NVIDIA, for example, doesn't just have a China problem, but even allies like the EU could face delays. Now, Jensen Huang is in Washington today arguing for a policy of diffusion.
We need to accelerate the diffusion of American AI technology around the world. And so the policies and the encouragement from the administration, it really needs to be behind that.
Diffusion, in other words, is the idea that spreading technology globally strengthens your position rather than weakens it. And it's very much at odds with the current administration's policy of containment. That's tariffs, export controls, and now potentially one-off chip deals. Diffusion is also, ironically, how China has closed the gap, rapidly open sourcing, sharing, and scaling its AI advancements. It's doubling down on that, too. Overnight, Chinese smartphone company Xiaomi released its first open source reasoning model, another entry that competes with the likes of OpenAI and public benchmarks. It's also a strategy, by the way, that is resonating with investors, diffusion, that is. While China's AI trade outperforms this year, seen through things like Alibaba or the K-Web ETF, American megacaps, they are under pressure after the president's first 100 days. And that's despite generous donations and outreach this time around, Kelly. This is going to be a critical topic going forward, how AI is negotiated, built, scaled in the future.
Without a question, the three businesses listed above are some of the largest AI players and NVIDIA's most important clients. Although the chipmaker has not disclosed the precise ranking, analysts from Bloomberg and Barclays Research estimate that NVIDIA's four largest clients, which account for over 53% of its revenue, are Amazon, 11%, Microsoft, 15%, Meta Platforms, 14%, and Alphabet, 12%. The argument that spending on AI and data centers is slowing down is debunked by recent remarks from a number of these tech titans. Although it appears that the AI revolution is still going strong, NVIDIA nevertheless faces difficulties. The tariff situation is still unpredictable and could alter at any time. Chip costs may increase, and NVIDIA's performance may deteriorate if the Trump administration's tariffs remain in effect. Furthermore, some investors remain cautious about AI's potential adoption and its potential effects on the company's future expansion. Despite evidence to the contrary, this attitude has continued. Nonetheless, NVIDIA appears more and more appealing to investors with a long-term perspective. The company is now trading at 39 times trailing 12-month earnings, which is close to the lowest multiple in more than 3 years. Additionally, for a business spearheading the AI revolution, its forecast price-to-earnings ratio of 26 is a compelling price to pay. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
What does this mean for the trade talks between the U.S. and Beijing?
Well, we have to keep in mind here, Shanali, that the current tariff level the U.S. has on Chinese imports is 145%. 20% of that was already implemented earlier this year over specifically China's role in the fentanyl crisis through the eyes of President Trump. The other 125%, of course, is the reciprocal rate that has been ratcheted up a few times. That is basically more to address China's trade practices toward the United States and the world overall. So in theory, this move from Beijing would be targeted at that 20% portion related to fentanyl. What the Wall Street Journal is reporting here, and Bloomberg has not yet confirmed this information, is that Xi Jinping's security czar, Wang Xiaohong, has been inquiring as to what exactly the U.S. would like China to do when it comes to some of those ingredients that are required in the making of fentanyl, has been making inquiries in that regard to see what ultimately might be able to address the U.S.'s concern here. Now, the people, according to the Wall Street Journal, who have been discussing this, say that the discussions are fluid, that China would like to see some softening of the stance and rhetoric from Donald Trump when it comes to his approach to Beijing and the trade offensive over versus China overall. But of course, this news follows the news we got from the Chinese Ministry of Commerce yesterday, suggesting they are evaluating whether to begin trade negotiations with the U.S., which in theory would be much wider than just address
addressing the fentanyl-specific issue. But keeping in mind, Shanali, that this trade war that has been launched with China, what administration officials and President Trump himself have effectively described as an embargo the two countries have against each other, are for a myriad of issues. It is not just about the trade deficit with China, but kind of its manufacturing capacity and overcapacity of supply in the global market overall, in addition to the fentanyl trade, which Donald Trump says is also part of a drug war, not just a trade war. So it is the fentanyl component that the Wall Street Journal says China is looking specifically at here.